I can officially say good afternoon, everyone. We have 12 o'clock. It's Liberation Day. I think I was a little nervous what's happening today. But nevertheless, I have the great pleasure to introduce you the panel for our topic, the role of fixed income in asset allocation. I'm happy to introduce you to four gentlemen. We have far to the left, Simon Fox from Aberdeen. Maybe you could say a few words what you do at Aberdeen.
Good afternoon, everyone. My role at Aberdeen is to manage bespoke multi-asset portfolios for a range of clients, from pension schemes and insurers through to charities, foundations, and then also some private banks as well. So a range of different clients, multi-asset portfolios, but tailored to a range of different requirements.
Thank you, Simon. Next to him is Matthew Morgan from Jupiter Asset Management. Matthew.
Hi, everyone. Thanks for being here. Yeah, Matt Morgan from Jupiter. I run the fixed income business. So we have roughly 11 billion euros across a number of strategies, which I look after. Also, thank you particularly to all of you for allowing us to do this in English, particularly you two guys.
We try hard that you understand us still. Then we have Sébastien Zöller from CAIA Swiss Asset Management.
My name is Sébastien Zöller. Thank you very much for sharing your lunchtime with us here for discussing fixed income. I'm responsible for the fixed income department at CAIA Asset Management. So in total, we have the privilege to manage roughly 300 billion in assets. 100 billion are in fixed income solutions, and 50 billion are part of my responsibility, together with 30 colleagues in actively managed solutions.
Thank you. Then last but not least, someone from a small Swiss bank. I have Marco Müller, please.
A small one that just became a little bit bigger, yeah. My name is Sandro Müller. I'm heading the fixed income specialist team at UBS Asset Management, covering all of our strategies, ranging from plain vanilla traditional ones like Swiss bonds, over to emerging market, or then also hybrid and the liquid strategies.
Thank you so much. I think we already found out we have someone on multi-asset, then 3 fixed income specialists, not only in a way of relative management to benchmark, but also absolute return, and then 2 gentlemen who also can see the Swiss franc situation, which might change from time to time, the way you should invest. So let's start with just the title of this panel, the role of fixed income in asset allocation. I think a lot was written about it, but it's the feeling that it has changed in the last 2 to 3 years. How do you see the role of fixed income in asset allocation today? Maybe Marco, you want to start with.
Sandro.
Sandro, sorry. Yeah. Thank you, I'm so sorry.
I think, well, generally speaking, fixed income probably has, I would say, 3 or 4 main roles that, of course, change over time. I would say, first of all, it's already in the name, income, then to some extent, capital preservation, and diversification and hedge. I guess if you think back to 21, 22, when we had all the central banks hiking rates in order to fight inflation, I think fixed income probably at best worked as a diversifier. Of course, if you look at 60-40 portfolios, especially in 22, not quite as much. What has substantially changed now over the last 12 months is, of course, that the other elements have come into play again. Fixed income now, after these hikes, offers yields again, thanks to now reduced correlation with equities. Once again, of course, also brings diversification to the portfolio. And I guess depending on your view, macroeconomic view, can potentially even serve as a hedge again, especially if you think about scenarios like stagflation or not a soft landing in the US, for example.
Thank you, Sandro. Matthew, what's your view?
Thank you. So I totally agree with everything Sandro said. But I think we almost learned a bit of a life lesson from fixed income in the last few years, because after the global financial crisis, we got very dependent on that negative correlation between equities and bonds. And we went through these repeated cycles where we'd have an equity market sell-off or for whatever reason, and we would all think at least we have fixed income in our portfolios. And fixed income didn't do that in 2022, and it's been very unreliable as a diversifier for the last couple of years. So I think the first thing is, and this speaks to those of us who really focus on active management, is we have had to go and challenge our assumptions over the last few years to really go back and think about what the individual component parts of fixed income do. And you have to get used to the fact that what fixed income does might change from year to year, which speaks to being active, and also speaks to thinking very carefully about what you have in your portfolios. And I think that's a good lesson that maybe applies not just to fixed income, but to US equities in tech or private markets. We need to keep rethinking what things are doing in our portfolios.
Thank you, Sebastian. A lot was said already, but maybe you want to add on, maybe also an angle on the Swiss franc investors?
So what has changed for me is mainly that you need fixed income again to manage your liquidity. So this is a big change in my view to the negative rates era that we had in Europe and also in Switzerland. So the difference between the current account remuneration and a market-based yield is significant. So there we saw a lot of inflows in the entire market. And with that, I think this changed a lot and showed as well what you mentioned, that there is some yield back. So for me, it's threefold. You need fixed income to manage your liquidity. And the second pillar, can fixed income deliver the element of stability again that you mentioned, Matthew? And this changed in my view because we are in a historic anomaly now. We are in a situation where fixed income offers positive real yields. And this is something that is not very often the case. So the yield that is paid on the market is higher than inflation in the majority of the large currency unions. And with that, I'm convinced that, generally speaking, fixed income can deliver the stability again to a portfolio in the situation of a market stress. And the third pillar of the three-folded element is really fixed income also as a yield generator. What has changed in the last 5 or 10 years is that fixed income generally has become so dependent on government bonds. So the part that is related to government issuers increased, and investors in fixed income, they are lacking a lot of corporate exposure. And this has changed a lot. Also needs to change a bit the assumptions and asset allocation to make sure that in your allocation you profit as well from positive trajectory within company developments and from credit spreads.
Thank you. That was just an excellent handover to Simon, which looks at it on the asset allocation view. So what's your opinion?
So fixed income has clearly become more interesting over the last few years. So the high yield means that you can think about it within a multi-asset portfolio. It's offering some sort of return potential to you in a way that it really wasn't if you go back 3 or 4 years. So fixed income is back in portfolios, but we don't quite know, I would say, what its role is, which talks to the idea of, do we think it's going to give diversification? Well, that slightly depends on the scenarios that we can see playing out in front of us, and there are lots of scenarios that we would look at where we think we don't want to have duration exposure because we can see US 10-year yields rising and dragging up bond yields. We've seen yields rising in Europe as well. So does it offer diversification is an outstanding question, but you feel from this point that we should be thinking about those opportunities and those potentials. The other question is, do we think it's a reliable source of returns? And then you get into questions around credit spreads and are they attractive or are they not? The one thing we've seen really over the last few years is people becoming much more focused on the types of fixed income they've got in portfolios. So thinking about the opportunities in private credit where you can find illiquidity premiums, but also being more selective in terms of some of those high-yielding types of fixed income, thinking about emerging market debt and not just high yield and those sorts of areas. So selectivity within the credit space, within the return-seeking space, I think has become more important. But also the outstanding question is, can we rely on it for diversification, or do we need to be a bit more cautious at this point in time, but see it as a source of stability, particularly at the short end?
Thank you. You mentioned it, Sebastian, that we had so many government issuers and heavy in debt, especially the US now with all kind of deficit, but also Eurozone. So let's start with just government bonds. So what's your opinion on government bonds? Is that something you're still investing a lot, more cautious, less cautious? What's your opinion on that, Matthew?
I mean, that's a huge question.
Of course, that's why we're here. We have you here.
I mean, look, government bonds here I'd be cautiously positive on at these levels, because I think to some of the comments we had, I do think that they give potential diversification in some of the more likely scenarios that I think going forward. We've seen a big move higher, as Simon was saying, in German yields recently, as you all know. And we have seen, in general, we still see pretty high yields, as Sandro was saying, on relative to inflation. I do think that from here, without going too much into the short-term macro, there are more downsides risks to growth than there are upsides. And therefore, I think that, you know, with government bonds at the level you have right now, they look like you want to have more of in your portfolio now than you did last year. But there are definitely a lot of unresolved questions around tariffs, around inflation, and around the sheer contribution of volatility of government bonds that you have now that you didn't have before 2022, that mean you just have to be more cautious. So I don't see investors going necessarily, you know, full on in here, but I do think that the last few years have created a scenario where so many people started saying, look, US growth is going to stay solid forever. Everybody that predicted recession in 2023 was wrong. Everybody that went long duration has been wrong. This is the point when duration starts to work for you. So I do think that it's time to start adding it back into portfolios.
Longer duration as well.
Longer.
Longer, not longer,
Yeah.
longer. Sandro, I mean, government bond was always the stabilizer, like the thing which is the less risky part of the portfolio, which you really had there that you can risk take it everywhere else. But somehow it feels a little bit different. What's your feeling?
I mean, we have a similar view as Matthew, actually. We are somewhat neutral in terms of positioning at the moment towards govie bonds, especially in Europe, as we've seen over the last couple of weeks. And in fact, going up into the macro picture, if you look at what's been developing over the last 12 months, you have seen so many changes in government with different policies being implemented, having a direct or indirect effect, and also on the country's different yields. Germany being the latest example where with this massive infrastructure program that they're about to launch, yields will potentially structurally rise, and that not just being the case for Germany itself, potentially also for other European governments. And against that backdrop, we're somewhat more cautious on Europe. I think overall, it can still bring diversification when it comes to valuation, and where we see more attractive segments. We actually prefer credit, that is corporates, investment-grade corporates, for example, over govies, given that we have currently a rather attractive yield pickup still.
Okay. Sébastien, you also mentioned that global aggregate as an index became also more and more heavy geared towards govies. So what's your thinking on that one? And then overall on government?
Well, on the govies itself, I think it's important to sometimes take a step back and to think about how does a government actually default? I mean, it's not such a simple question, because if you can print your own money, the probability that you default on your debt is, in my view, very low. So that Switzerland is not able to repay its money because Switzerland creates its money itself, the UK as well, the US as well. European countries, for example, don't, because they don't have the authority to print money. So in my view, as long as a country is indebted in its own currency, for me, it's not a question of imminent deterioration in terms of failure to pay. It's just a question as well, what is the value of the money that I get back? And I think we had in the last 18 months, we had a silent government default in Japan. So there was a situation where for a very long time period, the debt levels of Japan increased, and the currency remained stable. And I think nobody here in the room would say we had a failure to pay. But the money that you get back converted in other currencies like US dollars or in Swiss francs has devalued by 40–45%. So I think this is really the issue, to differentiate countries that issue debt in their own currency and the classical balance of payment crisis that you have for countries that issue in non-currency. And the European Union has kind of this vulnerability that we have also seen in 2012 with the failure to pay of Greece. There was a restructuring that you don't own the money press. So for me, it's not an issue of default risk. It's really an issue that because fixed income indices, they don't follow the same mechanics as equity indices. Equity indices, they follow the success of a company. If you are successful, you have more weight in your index, you have a higher allocation. So fixed income follows the amount of debt that is outstanding, that is not primarily a sign of quality, usually. And for me, it's rather a question, do I miss opportunities in the corporate segment because I'm so focused on the govie bonds and lose out on credit spreads than on various of the default risk?
You brought an important angle in it, especially with the example of Japan, with the yen. that comes up me to the mind that Mr. Trump thought that when you buy treasuries, you have to buy an extra fee because they are the provider of the good dollar, which the intention is at the end of the day the dollar should be devaluating. At the same time, it's treasuries, the most liquid bond market, which is around there, and also the biggest component of every index. So is that something which leaves you maybe too underweight, or is it depending on the currency you have in or so? Who has any thoughts on that one? Do you want to start?
Well, let me pick up, and I can answer the sort of the previous question as part of that as well. So within a genuine multi-asset portfolio where you've got equities, you've got real assets, you've got other diversifying strategies, you will typically always have some exposure to government bonds and high-grade bonds more generally. As things stand today, we are neutral to light government bonds in our portfolios. We can see the benefits of diversification if we have a recession. It's not our base case. And actually, where yields are today, we think they're fairish value, but there's a decent chance they will rise as well. So we've chosen to be sort of, as I say, neutral to light, generally speaking. One of the challenges is in terms of if we don't want to use them as our protection against recession, where else could we look for that protection? And you might have said the US dollar 3 or 4 months ago, and the world has gone completely against that. The Trump trade has not played out as many people were expecting. We've had positions in things like gold as an alternative diversifier, but even now gold has been hitting new highs, and at some point, that's feeling slightly rich within portfolios, but it has been a good diversifier thus far. So if you don't use government bonds, though, you are limited in how you might build your multi-asset portfolio to have some degree of protection within the portfolio. That said, the mandates that we manage that are much lower return seeking, much lower risk, generally more fixed income orientated, we have very little duration. We've moved everything really to the front end. Short dated credit, we think, is a better way of building those portfolios. Duration doesn't offer that much protection versus the credit, and we prefer to be at the front end to avoid the sort of the spread risk. We don't need the government bond piece inside of that. So how you think about the portfolio and what else you're matching in with it, I think influences from our perspective how much you would want to have in government bonds, but also what are the other diversifiers out there, and US dollar not being as obvious a diversifier today does influence some of that decision making. Japanese yen sort of comes back into play, having been out of favour for a number of years, I suppose, in its place.
Matthew, what's your thinking on that?
I'm thinking on diversification specifically, or
especially on the US dollar, the treasury. If something, if assuming your portfolio is not dollar portfolio, it's a euro portfolio in your perspective, not a Swiss franc endeavor. Therefore, you have this treasury market, which something similar could happen. What Sébastien elaborated on.
I mean, it is extremely difficult right now, and I'm never a fan of people who say that the market is uncertain, because it always is. But right now, it is particularly difficult. And I don't say that often. I think because, Simon was saying, you can build a case for a lot more yield volatility driven by tariffs, driven by Trump. And we have seen repeatedly the disappointment of people who thought that yields were going to come back down to something a little bit more where we would call neutral. And then you've seen another inflation scare, or you've seen growth pick up. At the same time, given the volatility we've just seen, as Simon referred to, the sell-off we've seen in the dollar, your ability to add risk in portfolios, even at these levels, is I think a lot of investors are pretty wary of. So where do you go? As I said earlier, I think that adding, when I say going longer duration, a lot of people are underweight. I would start to think about closing that. Secondly, I do think there is more value in the dollar here than there was. So that is something that some of our managers have been starting to close underweights in. The other thing I would say is, when you're looking from a more of a multi-asset perspective, which I know is strictly Simon's role, not mine, so you don't mind me treading into your turf, I do think that the ability of credit here, given the all-in yield you're getting. Now, I'm always aware that my high-yield manager says to me, when people start talking about, don't worry about spreads, look at the all-in yield, that's a sign that credit's overvalued. But when I look at credit compared to, say, equities, if you run through your scenarios and you think, inflation, maybe it does go a bit higher if yields sell off again. and or if you get a stagflationary environment, yes, I do think there's upside to spreads, but I'm way more worried about my equities in that point. So, particularly given the technical strength we have in credit, the lack of issuance, the competition for private credit, I do think that having, even at these still tight spreads, a reasonably robust credit allocation is a place to look, just alongside your equities and duration.
I'm not so sure if I'm so happy to listen to you. Said, okay, I lose but I lose less than equity. That's a little bit the question here.
We're being honest here, right?
But I see the horses are already out there. You always want to say, well, credit, I was too long on the interest rate and on govies. So let's move on, Sandro, please. What's your thinking on the credit risk and what's in your portfolio? Where do we see opportunity? Where do we stand here? I mean, we had super tight spread for a long time. It has increased a bit in the recent days. So what's your position and thinking on that?
I mean, as Matthew has rightly said, right? Probably if you look at spreads, it doesn't look overly attractive. I mean, if you compare this, as you said, over the last couple of weeks, yes, we've seen some widening, but historically we're still trading very tight. If you, of course, then look at the all-in yields, we are actually looking at the top 20% compared to the 10-year history. On the spread side, it's the bottom 25%, so indeed it's still very compressed. From a Swiss perspective or a Swiss franc perspective, of course, it always looks much more attractive if you see this, bar charts where for US dollar, euro, you have much higher values. The question is then, does it warrant, and that goes back to the question about the dollar, for example, or currency in general, does it warrant to sit in non-Swiss franc credit where you have still attractive all-in yields if you consider that probably it's worthwhile hedging it, especially from a fixed income perspective? I mean, on the equity side or generally more risky assets, hedge funds, commodities, I would argue it probably makes sense to not hedge your currency exposure, your non-Swiss franc currency exposure, but generally speaking, I guess for fixed income, you can say the volatility caused by interest rate moves on the FX side is about twice as what you face on the bond side. And as such, if you look, for example, at credit year to date, at USIG, which at 5% sounds like a very attractive level, that's done about 3% in local currency year to date. But then look at what US dollar versus Swiss has done, which is about 2.5% negative. Doesn't look quite as attractive anymore. So whilst we overall have a positive view on credit, we think at the moment actually it makes somewhat more sense to stay in Swiss franc bonds. If you look at the SPI, you have about 1% yield. If you look at the global ag index, for example, and at the hedged back version of this, you look at it only about 50 basis points yield. So at least in terms of what you can earn on a yield basis, Switzerland clearly is currently our preference. Then, of course, what you also need to account for is gains from potential duration exposure or falling yields. But just at the yield level, we think at the moment it really warrants to stay local instead of looking too far outside of Switzerland.
Thank you, Sébastien. He elaborated very well on the currency hedging, especially when we have an inverse interest curve still in the US dollar, which also makes hedging a little bit less interesting, but especially from the Swiss franc perspective. But then, of course, you can also go to corporate, but maybe you just want to address first the hedging problematic.
I completely agree with Sandro with regards to the high-grade part, also from an after-tax perspective. So in Switzerland, you pay taxes on the coupon income, not on the hedge coupon. It's very important to remember. So I think there's no historical evidence that you achieve a better performance by buying a high-grade portfolio, hedging it back into Swiss franc, than just staying in the quality here. I see it a bit different on the corporate segment, because the corporate segment in Switzerland is very, very small, very coincidental, so you don't get a good diversification. So there I think the combination of the quality in Swiss francs and the global but currency hedged corporate portfolio makes a lot of sense. With regards to credit spreads, personally, I'm with the jargon, I'm quite constructive. There's also another jargon that
I like it.
People are hated for it. But let's use it, and maybe a few words why. If you look at past credit crises, there was always the link that transformed a local problem into a global problem, and this was the financial system, the balance sheets of banks. So we saw it in 2008 with the financial crisis. You had a local problem, subprime in the US. Then we found out it was invested in every bank globally. It became a global problem. Euro crisis, 2011, the same. COVID anyway. Now, in my view, banks have been very successful in getting much more robust. So their earnings power is better, their capital ratios are better, so the vulnerability is much less. And you see this evidence already we had the commercial real estate crisis 1 year ago. It could easily be absorbed. We saw different fast takeovers of banks, Silicon Valley Bank, Credit Suisse in Switzerland, that all they did not become a global problem. And this is, in my view, the ingredient why the credit market is attractive or is resilient. It's difficult to time. Maybe spreads widen a bit because equities have a bit of a challenge, but structurally, I think it's a premium that must be in a portfolio, especially in a fixed income portfolio also now.
Then, yeah, please.
So I suppose I have I think a slightly different take to this to everyone else. So to some extent, it depends whether you can disconnect your duration exposure from your spread exposure. Yeah. And can you treat those as independent allocations? And increasingly that's possible because just the growth of the ETF market means we've got more tools, more ability to do that. And in that case, then I would think about the duration question differently to the credit question. And that leads me not to have very much in high yield because I think the spreads aren't particularly attractive. I think the upside is pretty limited. If I'm going to take risk, I would prefer to take it in equities over the medium term. The thing that's going to allow high yield to perform over the next 12 months, in theory, should allow, particularly after the recent sell-off, a recovery in equities as well. So I'd prefer to take that risk in a slightly different way because I can bring the duration back independently. If I can't do that, then there is merit in high yield because high yield does effectively give you two things. It gives you that duration and some spread on top of it. And from a capital allocation perspective, it can be quite interesting to do it. You can then think of it as an all-in yield in a way that you might not if you're able to separate the two. So I think there are two different uses, but generally speaking, spreads are tight. Spreads are really tight, and we've got to be nervous that those spreads are going to widen. But it does depend on your tools available as an asset allocator.
Thank you. I think that's a question for you, Matthew, since you're really on the fixed income part. So high yields, you don't have all the tool set what Simon has in there. So for you, just move on like the extended market, corporate high yield, maybe loans. We can also talk about that. Banks are still unwinding balance sheets, etc. So how's your position you're thinking there? Of course, spreads are somewhat tight, but it's all a relative game. So what do you act on?
Look, in absolute terms right now, relative to history, for the reason that Simon said, buying high yield in absolute terms right now doesn't make sense. I would expect there'd be some spread widening and then maybe a better entry point. When you look at a total portfolio, though, and you're looking almost desperately at the moment, given people don't trust duration in the way they used to, you can look at alternatives, you can look at gold, but those aren't really my field of expertise. I do think that you want a reasonable amount of credit in your portfolio alongside your equities, right? So I do think that there is a diversification play there. I think, though, it does depend on what you're owning. I think there is never any sense in holding high yield passively for the reasons that we talked about with regard to index construction. You own more of the most indebted companies. It doesn't make sense that you're making that point. But particularly right now, there are some really interesting relative divergences in high yield. Right? If you look at certain parts of what you would think going into potentially a more difficult economic environment as more vulnerable sectors, such as energy, particularly in Europe, you actually see companies where, on a spread basis, the risk of recession is actually, or risk of a slowdown, is pretty well priced. So when I look at the high yield fund that we have at Jupiter right now, and I'm not here to sell a product, but it's really interesting to see that in general, credit risk is less than the benchmark, but the yield is still higher. And the reason is that you can right now look for, to take risk off the table if you're a high yield manager, but there are some really interesting pockets where you would think counterintuitively you don't want to own this if there's going to be a slowdown, but actually you're getting priced for the risk you take. And that comes back to the key difference always between credit and equity is, if you have reasonable confidence that something is not going to default, restructure, or devalue, to your point, you can put money to work slightly earlier if you do think that the macro environment is going to be a bit difficult. So it does depend on what you own. There's some very interesting opportunities we see in high yield right now. But yeah, in absolute terms, spreads are expensive, there's no doubt.
So that would be underweight, but good security selection if I
exactly.
listen carefully to you. Sandro, corporate high yield or maybe loans, what's your positioning? I mean, there's a lot of refinancing probably coming. The refinancing wall, everybody's talking there, but somehow it seems to extend all the time. So the wall is maybe, is it there, not there? But it's still, we have a very high interest in US dollar, not on the long curve, but the short curve. So yeah, maybe in light of that, what's your positioning?
As you correctly mentioned, I think maturity wall is a good point to start. It's been a big concern for a lot of investors that were looking at the space. Looks to me it's rather becoming a stair. About 50%, if you look at the US high yield market, is about to come due in the next 3 years, which I guess if you look at an index which normally has an index, a duration between 4.5 years, somewhat natural, so it doesn't seem like overly steep for me to manage these refinancing events. I think the combination of all these elements, fundamental elements, if you look, for example, at net leverage, interest rate coverage ratios, which have stabilized post-COVID. If you look at spreads, which meanwhile have become more attractive again, not quite as much, of course, compared to the last 10 years, but if you look at US high yield at 350 bips, Euro high yield at 320 bips, then I guess you can make the case. We favor European high yield over US high yield. We think that the valuation is more attractive. In fact, if you swap it back to dollars, you still have a higher all-in yield in dollar. If you look at the underlying structure of the market, it's also a much more conservative one. In fact, you look at much less cyclicality. You have a large weight in financials as opposed to in the US, for example, large exposures to natural resources, energy. You have, when you look at the credit quality, about 70% in Europe sitting in double Bs, or the other way around, only 30% in single Bs, triple Cs, which for the US is about 50-50. All in all, I think also if you include then the expected default rates, which are supposed to come back at historical levels, there is a case to be made for high yield overall. For the US, we probably would prefer the short end, and all together, certainly the Euro high yield market over the US one. I think, don't want to steal too much time of the other colleagues, but an interesting comparison, of course, also leveraged loans. A lot of attractive elements which we think also warrant a closer look, given the fact that you sit high up in the capital structure, you have normally secured assets against that, you have seniority. The most, I guess, attractive element in that sense is currently the floating rate characteristics of loans, given that we don't really know where long-term yields might go. And again, the valuation, here you look at about 400 basis points in spread, altogether for US loans, almost 8%, even hedged back into Swissies, about 4%, or 4.5% even. So we think that within the credit space, Euro high yield and then leveraged loans certainly are attractive spaces to take a closer look at.
You mentioned default rate, expected default rate. I heard that some people said this default rate itself is less meaningful if you compare it to historic numbers, since more and more restructuring start earlier because of some covenants whatsoever than before actually defaulted. Is that something you've seen? That means it's a new area. You still, of course, see where default crisis could come, but it's just historically seeing it's lower, maybe it's not the full story. Is that correct, or is that not just an angle which some fixed income manager told me, but maybe you have a different opinion, please? You're the specialist.
Yeah, no, I think what really changed in high yield is that the high yield pocket itself has been shrinking because you have other pockets of risky credit that really have grown, like private credits, the unitranches, all these kind of deals. And what is astonishing is that you mentioned the refinancing wall. What is for me a positive element is that a lot of issuers that were struggling to refinance in the last 2 years, they got help from private markets investors, very heavy help. Large capital structures, very fast.
So they went out of the liquid market.
I don't know whether it's maybe a sign of excess, one could argue. I think it is. But in the end, for the agility of high-yield issuers to restructure, to find solutions in terms of stress, it really increased their flexibility. And overall, the size has been shrinking. So it's not that you have an excessive growth, everyone went into high yield, find easy credit. It got more selective. And with that, there is also more money that is chasing fewer issuers. So I think it's not such a bad combination. And we've already seen a widening from 250 to 350 within 4 weeks. So I would say also recession probability, usually in a recession, US high yield goes to 600, Euro high yield to 450, and then also the cracks are coming, but we've already seen some way. It's not that we are on the tightest levels now. There is already some protection back in the market.
Sorry.
Yeah, you both of you both have something to say. I see. Matthew, please first.
I agree with you. I mean, and it actually goes back to the comments on banks earlier. We have seen a huge transfer of risk from the banking system, and a lot of that has been picked up by private markets. And there haven't been the defaults we've seen in the high yield market have really been because of, off the record, badly behaved French companies that are allowed to rip off creditors. Those are the defaults we've seen. We have seen some amending and extending, which is not great for creditors, but you get your money back. It hasn't been a severe weakening, and a lot of that's because, we see this all the time. Companies will come to us with a price we don't like, and they'll say, take it or leave it, we'll go to private credit. I don't know enough about private credit, it's opaque, but I definitely see the risk if what we're seeing going to private credit is what we're seeing, that there is more weakness there than is understood. But the good thing is that, touch wood, that shouldn't be systemic because you're outside the banking system in a, hopefully less levered world. Sorry, Sandro.
That's right. So there are a few different things that have come up, so I'll try and run through them all. In terms of the default risk aspect, of course, the pain for investors is that spreads widen. So the default is the end of that piece, and normally something else has happened. So, we can say, well, there might be fewer defaults, but we shouldn't get sanguine about that because it's the spread widening that is the pain for most investors. In terms of the sort of the high yield opportunities, I agree that the stock selection piece is really interesting. We would go sort of further than that in our enhanced income funds, we're not only sort of, which are primarily investment grade, where we find the return enhancement or the yield enhancement. Partly it's in that sort of triple B, double B space, but it's also looking at things like Asia and the emerging markets where you can find some still high quality companies, but you have an additional spread on those credits, which can help enhance yield as well. So we can expand that toolkit as well outside of developed markets. And then the final one on private credit, I agree, certainly in the sub investment grade space, there are risks there that I don't think are fully understood necessarily by all the investors that are going into it. I wouldn't cast the whole of private credit in that way. So I think there are some really interesting opportunities, particularly in asset-backed space. So commercial real estate lending, we still see some really attractive opportunities. Niche areas like fund financing, we see some really attractive opportunities, but they're not exposed
and not liquid market. We are here in liquid market panel, so I think we could do a whole hour about private markets there. So I would like to stay on the liquid part of the market. You mentioned emerging market somehow. Of course, they also suffered from the huge US dollar interest rates 2 years ago. I haven't seen lately so much on even that, but I think it's still a toolkit you use. And Sandro. I think, of course, it's three components. We have external debt, we have local, and we have corporate.
Corporates, indeed. I think the problem, if you want to call it this way, of emerging markets currently is that, notwithstanding relatively solid fundamentals, positive credit migration. I think if you look at the EMB, for example, there's only a handful of names still in restructuring with IWF help. If you look then also at other elements, except flows, you can tick a lot of boxes. The problem, as I said, is that currently a lot of other segments, especially credit segments, are still yielding as much. Sort of the tide has lifted all boats. The risk-free rate that's been pushed up by central banks hiking has led to any credit segment, be it IG, high yield, or an emerging market trade at multi-year highs. And as long as you have somewhat less risky segments that yield you quite as much as they do currently, I think a lot of investors probably are not forced quite yet to take a closer look at emerging markets. And that's exactly what you see in flows. If you look at where money has been going, European domiciled flows, you have seen money going into high grade, investment grade, to some extent, meanwhile, even high yield, anything but emerging markets. So I think what EM needs sort of is an overall lower yield environment in order for investors to look further than what they're used to currently.
Sébastien, on EM.
So for me, it boils down, so I would like to focus actually on the local currency emerging markets segment, because corporates, it's not my expertise, emerging market, and hard currency for me at the moment is rather a question about where is the US Treasury going at this level. And in my view, people underestimate the potential that local currency offers at the moment. We see just an example, Brazil is at the level of 15% interest rates, 6 to 7% real interest rate that they're paying, 6 to 7%. And Brazil is not a country that is particularly exposed or more exposed to than other countries to potential tariff threats and so on. So in my view, the fight against inflation in the last 3-4 years has been done in a more serious way in many emerging market countries. And I think the question is then, have we seen the peak of this US exceptionalism with this attractiveness that attracted so much capital to the US and led to the appreciation of the US dollar? And I think now, with the changes we see, there is a good chance that economics starts to count again, and there, local currency, in my view, is a very underestimated pocket of value at the moment.
It's our largest position within the sort of the high yielding space at this point in time. So we would echo that as well. And actually it has some more interesting diversification benefits than I think is generally understood. The challenge is dealing with the currency and almost the volatility of the US dollar. But if you can build in, you can use sort of baskets of more economically sensitive currencies to help manage that side of things. But you can create a profile which is actually pretty steady and pretty reliable over time. And as you say, the opportunity set today, particularly if we've seen the end of some of the US dollar strength, is pretty compelling.
Matthew, you want to add on?
I was sort of thinking of my answer, and then I realised that Sébastien was giving it. Absolutely. I think
that's okay. You don't have to. Everything is said.
But let me try to marry it. I think the problem is, definitely from a top-down perspective, I think the problem with Brazil is, we all agree on it. It is pretty consensus as along, and we did see it didn't take much for that to be quite painful at certain parts of last year, just because so many investors were long that a short move there was quite a lot of volatility when there was some bad news. So I'm a bit wary of that. But just to say it in a different way, central banks did really well when they saw inflation coming in 2022. Emerging market central banks thought, well, inflation, let's kill it. Whereas the US and Europe were thinking, nah, it'll go away. So they did a great job, and that means they have a lot of space to cut rates. If they get into economic trouble. I think the really hard thing is, as you were saying, it's very difficult for investors to selectively implement EM in their own portfolios, because holding the MB here when you have large Mexico allocations, or for example, exposure to China or around Asia, I think that's much harder. So it is hard to invest. So it probably sits more within a flexible portfolio.
So thank you very much. I come to the final question before I open up to the audience. You said at the very beginning, we have real interest rate on change. So therefore, the question is, where is inflation going? And if all of you can give a short answer, US dollar, euro inflation, and for those from Switzerland, the Swiss franc inflation, maybe where do you see it in 1-2 years from now? Simon, if you want to go ahead.
So if we're doing very short answers, my concern is that it's not going anywhere, i.e. it's staying sticky, which is why we are being cautious around duration, slightly range trading the duration position. So as yields are coming down, we're taking the opportunity to take a little bit off, and as yields are going up, we're generally looking to add back on. But we think certainly across the US, we don't think it's going anywhere, and from the UK perspective, inflation is a whole other thing as well.
So the Trump administration is playing chicken with markets right now, thinking that they can implement tariffs without causing too much inflation and get to this sort of very, very narrow landing ground. My concern is that you've seen in the last few days the market is starting to price higher short-term inflation. It's really interesting that longer-term break-evens haven't moved. So I think we're seeing a bump in inflation right now, but I think that the Trump administration is more likely than not to get this wrong, and uncertainty that they create will cause a worse economic outcome, meaning inflation down, yields down by the end of the year.
So how boring to start with the Swiss inflation. I mean, so the biggest components, rent, energy, and healthcare. So I think we will not see higher inflation in Switzerland, especially now we have with the administered rents. So currently we are at the level of 0.6%. So I think we will stay below 1% for a very long time period in Switzerland. So I don't think that there is so much to worry from that. Maybe I can tweak your question a bit. So for me, the key question is internationally, do we stay in an environment with positive real rates? And there I think no. I think we are in a situation now where governments don't have enough money to fund what they promised. And so I think the bar to lower interest rates, also to make debt affordable again for the governments is very low. So my expectation is that we will first see it back in the US, negative real rates. So that doesn't mean where the level is, so it's a diplomatic answer. And Europe could surprise to the upside, because what we see now, if there is no complete execution failure on this infrastructure program, there is some chance that this is the case, because there is a lot of public processes involved. But if not, then there are clear scarcities that are emerging. So 100,000 of employees in Germany are not there to deliver what is actually ordered. This will, what would be my reaction as a company? I would raise prices. I would try to raise salaries to attract talent to do it. So I think there is really upside surprise possibilities with regards to inflation and rates in Europe. So we could see a situation where Europe is offering higher rates than the US, what would be very, and I would say history, something new, but I don't think that is completely unrealistic in the next 2 to 3 years.
Thank you. Sandro?
Well, I mean, the colleagues covered the US, Switzerland, and to some extent also Europe already. I think not going to give the same opinion, which, we have more or less seemingly. What's not widely talked about, I think at this stage, is a feedback loop in Europe. Sébastien has somewhat alluded to that already. What we've been seeing since the announcement of this Sondervermögen and this massive infrastructure project that still needs to be executed is, as a first reaction, an increase in yields, not just in Germany, but also other European countries, which I think ultimately is not that much going to be an issue potentially for Germany. I mean, they have a low starting ground in terms of debt to GDP. We're looking at, I think, mid-60% levels. But the feedback loop that could occur due to this program being executed, of course, is that if there's a structural longer-term increase in yields, countries like France, like Italy with about 130-something% of debt to GDP, will potentially face issues if they have to refinance at levels of, let's say, 5%, which then again for the ECB would also probably pose the risk of not being able to cut quite as much as they would like. At the moment, I think there's still some 2-3 cuts priced in until year end. And that, of course, then could pose a bigger risk in terms of inflation. Ultimately, pricing pressures might increase due to this additional spending of governments in Europe.
Thank you so much. I think that's a good marking spot to stop on, and would like to open up for questions. Please. I'm so glad I don't have to answer that. So risk management, I think it's actually a risk management question. What's going wrong, best and worst case? So
I don't know which way round you put it, but of course that we're going to see much lower 10-year yields in a recessionary environment, which is probably the worst case, but the best case for holders of government bonds. And you could see, in that scenario, you could easily see 150 basis points lower 10-year yield in the US and similarly coming through in Europe. Probably might have different numbers in our risk models around that, but that would be the way you get much materially lower yields. In the opposite side, it's what's the good side from a growth perspective? Well, I suppose from a US perspective, you could see Trump returning to something which is much more constructive for markets, which could see growth returning, stronger performance economically in the US, which actually can allow 10-year yields to stay where they are, maybe come down a little bit from where they are. The upside for Europe from a growth perspective, or if we saw a bigger move in places like China to try and solve their challenges, those would, I suspect, come with higher yields in Europe. So the upside growth potential for US could come without meaningfully high yields, but I think in Europe it would, which I think is the point you were making as well. If we see that bigger fiscal boost, if we see some of the Draghi reforms coming through as well, and you're seeing a real upswing in European prospects, then I would imagine European 10-year yields would be higher, maybe 75 basis points, 100 basis points, whatever you might think.
Yeah, I think, again, listening to that, I agree. But I think it also, that's what's so interesting about duration here, because it's so hard to predict. But I do think the outlook is asymmetric. In the sense, I find it very hard, unless the US has, an event like the UK had in, sort of under previous Prime Minister, where you saw yields rising out of control because there is a fundamental view that the US has lost control of its economic or fiscal policy and is unlikely to be able to pay or is going to do something crazy on the restructuring side. I think that is so unlikely. And I think that we have seen the peak in inflation, that I think you can look, I don't see yields going above the peaks we've already seen in 2023 and 2024. But as Simon says, I do think that you can easily imagine a recessionary environment, 150 basis point move, or not easily, it can be pictured 150 basis points lower. And that means there's an underweight to be closed, something that can help in a recessionary environment, which looks more likely by the day, because I don't see the upside to yields being anything like the downside.
Thank you. It's important to add, otherwise to open up for further. Yeah, please. Short.
Talking about extremes, not about probabilities.
Yeah.
About extremes, not about probabilities. So for me, the worst case scenario for the world, but for the US yield curve, would really be a repeat of the 70s, where we suddenly end in a situation where the US needs to struggle or is struggling to attract the capital it needs. I think this was then in the 70s. I've not been part of the financial community then, unfortunately. But so there was a constant dollar devaluation, a constant dollar crisis, political uncertainty, and it needed Paul Volcker actually to really raise interest rates to attract the capital to stabilize the US dollar. Debt levels now are much higher. And then I would imagine that 10-year interest rates would go far higher than we have seen at the 5.25% we have seen 2 years ago. But that's really, in my view, very, very low probability. That would be, for me, the worst case, where we could have a repeat of the 70s. You cannot attract the capital. And for the lower side, I think we are way too anchored on the current yield level. Maybe if you remember 2018, 2019, inflation was above 3%, growth was weakening. Suddenly S&P 500 in the fourth quarter lost 20%. And then the next step was to put a lot of pressure on the Fed. We all remember that. And they introduced QE, they introduced sudden rate cuts, and we are at 4.5%. So 1.5%, we are only at 3%. So in my view, if there is a recession, we will be lower than much lower.
Before the pandemic, banks were preparing for a deflationary bust.
Exactly.
Right. Amazing.
So Unfortunately, I have to come to an end. Thanks for an excellent question.
Thanks,
Because I think it's great to have so four bright gentlemen with a lot of experience here. I think we covered a lot. Fixed income is a role in asset allocation all the time. We have so many different things, and it definitely feels differently than 2-3 years ago, but it remains interesting, and we learned it's not difficult because it's always uncertain. That's what I understand as of today. Thank you very much, and have a great afternoon.
Yeah.